Welcome. Wednesdays. We've got wealth on Wednesdays once again. Welcome. Jump on in. Come and get some of what we're talking about and come to understand you do not have to die broke. You can master your money, learn how to master your money, obtain financial freedom, and do that with financial literacy. And that's what we're promoting here, financial literacy. Understand and develop an understanding of what you own and how those assets can be of benefit to you, your family, and your future. God bless. Here we are, Wealth on Wednesdays, and we're talking about five S&P 500 stocks paying 5% or more in dividends. Five S&P 500 stocks that you probably are aware of these companies and what they do, and they're paying dividends of 5% or more. And without any further ado, let's just jump into this and get to this right now. Here we go. If you notice, I've added a bonus on there. And that is Ford. I recommend Ford myself, right? Because Ford is definitely a holding that I have in my taxable account, multiple taxable accounts. And I think Ford, trading, under $14 right now, and it's paying over 5% in dividend yield, and it keeps going back and forth, climbing. But I've had Ford for a while, and I'll say Ford is a recommendation that I would make for someone that's unsure about a lot of things, but it's still cheap and it still has a great benefit. Pays well. Here we go. So my other five, starting off with Kraft Heinz. This is a consumer company. They make products that we're all familiar with, right? Kraft products, Heinz ketchup, all of those household names that are under the Kraft and Heinz brand are here. The stock's about $25, and it's trading with a yield of about 6.6% right now. 6.6%. Well over 5%. It's a steady holding of Berkshire Hathaway, Warren Buffett fame. And so definitely Kraft Heinz. I would get into Kraft Heinz now while it's still under $30, while it's hovering at $25. I would get into it. I continue to buy into it. It's a solid holding of mine, taxable, not in a tax-free account. And I tend to hold fewer stocks in my tax-free accounts and more stocks in my taxable account as far as individual stocks. So when you hear me say the disclaimer of what I own, understand most of it's going to be in my taxable accounts. So get into Kraft Heinz. People are still buying ketchup. People are still buying cheese. That's part of it. And so if you're going to get into a consumer good, get something that people are buying, not that people are only buying every now and then or only around Christmas. Next, United Parcel Service, UPS, 6.9%, right? 6.9%. And UPS, just over $100. Had some labor issues with the drivers some time back, but that seems to be worked out. And they're in the delivery service, but keep in mind they have the UPS store, which also, if you're ordering Amazon and making returns, That's one of the places that they recommend you go to make returns, the UPS store. So the UPS business is booming in its B2B services, business to business services that it has with Amazon, not only in delivery, but also with its returns. Imagine that. So UPS, United Parcel Service, Big Brown, what can Brown do for you? Brown can pay you almost 7%, right? And so that's a nice chunky dividend right there at almost 7%. And the stock is inching up. It's over 100 bucks right now, but look at it. And that's a solid play. I own that as well. In fact, I'll be honest, I own this whole list today. I may not own the whole list when we do part 2, but I own this whole list in taxable accounts. So let's just get that out of the way right now. Verizon Communications, right? 6.6% yield. This baby is staying up there, and there's no real fight with Verizon and AT&T as far as telecommunications. Verizon is doing its own thing, and it just hasn't gotten beyond the $50 mark, right? I wanted to get beyond $50 at some point, but Verizon has gone 40 down to 35. It's back up into the 40s. It hasn't got beyond the 50 mark, and so Verizon, I would like the trading price to go up a little bit more as far as the stock price, but I love the yield at over 6%. Verizon is steady, consistent, no heartbreaks there. Franklin Resources, Ben. People may not be familiar with Franklin in the same sense as they were decades ago. And Franklin's kicking off 5.5% financial services. Franklin is your mutual funds, ETFs, primarily retirement accounts, 401ks, as far as options within your 401k. Big deal as far as that. Are they getting squeezed out by T. Rowe and BlackRock? That's a competitive market, but Franklin appears to be holding on strong for a extended period of time. And I would say Franklin remains a good producer, kicking out 5.5%. So I'm still holding on. And that trades, like I said, around $25. And it's still a good, solid financial company with a history and track record of delivering for shareholders as well as investors. So that's one that I've been a darling of for years. Some of my original retirement accounts had Franklin funds. I say go with it. Go with it. If they're paying at this rate, this is a solid financial company that's not competing with big banks, right? And that in the retirement industry, which still is an open market as we increase our millennials and others that get into retirement. Let's see if this pays off for Franklin down the road. Next, ConAgra Brands. ConAgra Brands. Do you not know that ConAgra Brands, look at this list, ConAgra Brands is at 8.2, definitely over 5%. ConAgra Brands is one of those companies that is solid. You can get it from anywhere from $30 when it has a bad time. They're down into the 20s, right? I say ConAgra Brands is a good company because they divested some of the brands that they had under their label, right? And I think that they can still do some things with groceries and snacks. Anybody heard of Marie Callender's, chicken pot pies and frozen foods like that? Bird's Eye, ConAgra Brands. That's who they are. And so they provide grocery and food that we get from our stores, just like Kraft Heinz. And so Conagra Brands at 8.2% yield is definitely one of my faves. I like when I see that roll in and that payday come, and I take it. I said Ford, and look at Ford, 5.71%. I don't know why Ford isn't one of the first listed companies when you search for S&P 500 stocks paying 5% or more. That all depends on what you use. If you use Gemini, Copilot, whatever you're using when you're searching on the internet, AI, ChatGPT, just make sure that you do an exhaustive search and research into everything that you look for. I say Ford because Ford is a competitive automaker. They're a competitive automaker, and a lot of these companies don't do their own financing anymore. Ford is still there. Ford is still kicking out deals. If you notice when you check online and different offers from auto dealers, Ford is still up there producing things, big things like trucks, SUVs, as well as commercial vehicles. And Ford is moving into the lighter side of things with EVs as well. So they're all around. They're competing with the rest of the guys. Look at Ford. Ford is a darling of mine. I've had them when they were struggling and almost nothing. So here's the analyst recommendations, right? Those that are recommended for a hold, right? They're telling you, if you have it, hold on to it. They're neutral, or don't just jump into it. Here it goes. This is something you need to pay attention to. We've got Franklin Resources, ConAgra, Kraft Heinz, and Ford. Those are hold recommendations. Those are ones that they're saying they're not a strong buy, they're not a buy recommendation, they're a hold recommendation, or they're neutral. Cool, no problem. But remember, analysts are typically recommending buys based upon growth. They're not recommending buys based upon dividends all the time. And so as a dividend investor, I'm looking beyond just the recommendation of analysts, because they're also keeping in mind the analysts have different approaches in their analysis of companies. So that's one where you can see, okay, these guys are saying hold on these companies. But what does that say about the rest of the list? Well, the rest of the list, it goes kind of like this. They're saying buy. And maybe not a strong buy, but definitely buy Verizon and UPS. That's what the analysts are saying. And so if you get an opportunity to get into these companies at decent prices, right? You don't have to wait for a dip. They're still low right now. Get them while they're affordable before they skyrocket somewhere and you're out of the price range that is decent for you to get into. How can you get S&P 500 companies for cheap? Doing some form of dollar cost averaging? I say do that with Schwab. Use Schwab slices. Schwab slices are where you can buy S&P 500 companies, right? You'll buy S&P 500 companies with Schwab slices, and you can buy them at as low as $5 per stock. So you can buy them in pieces, take $20, buy 4, $5 each, come back in 2 weeks when you get paid again, buy those same 4, and continue to do that with dollar cost averaging. That's one way that you can do it. You can always go to Robinhood or another company and buy into stocks for $1 or less per share. $1 per share or at the minimum, and get in there. You can go to other companies as well that trade on another level like SoFi or Webull. But my recommendation is definitely hit up Schwab slices. If you're using Schwab as your investment account, you don't have to go anywhere else. You can still do it with Robinhood. But those are just two ways that you can get into S&P 500 stocks for cheap, and you can get these dividends paying you consistently. I use dividends in my taxable accounts because of how I want to have some things structured and some flexibility with some paydays and income. I'm definitely a dividend investor, and I also use some dividends in my retirement accounts, but not primarily through individual stocks. So look at that. Look at what works for you. Find what fits your situation. Like I said, find what fits your situation and utilize that to help you make decisions about your finances. You don't have to die broke, right? Going back to the money flow game and everything we learned from Gerald Peters, you can be an investor, buy and hold, get those dividends coming in, have that extra payday, which works for you almost like another work day. And that can be your passive income if you build up enough in dividend investing to where you're able to amass funds coming in on a regular, consistent basis, whether quarterly, monthly, or otherwise. And those paydays can be reinvested into the same funds, and you can continue building until you have a groundswell of investment income to where that can serve as another form of passive income. Hey, like I said, this is Wealth on Wednesday. Rev Bruce, I want to thank you for joining us. Remember, if you get an understanding of your finances and how to build wealth through financial literacy, you can obtain financial freedom. And in doing so, you can make money and not die broke. God bless. God be with you. I hope everything works out for you in this day. Check out more on the channel as we dive into some other investment strategies. God be with you. God bless.